Hi, everyone. It's Fredy Sarmiento here. I'm a futures trader. And here we have, today we have a Jasper, which is the founder and also a futures trader for Gexbot. Hi, Jasper, how you doing?
Great. Hi, Fredy.
Hi, man. Hi. Thank you so much for taking some of your busy time to be here and try to explain a futures trader how to actually trade the futures market with Gexbot. I know. We've been a couple of interviews with John in Spanish. So probably what I try to do, we're gonna do this one in English for the English speaking community in the channel, and then I'm gonna do kind of the translation into Spanish so we can show it in Latam.
Yeah, that sounds great to me. I know that I've done quite a bit of rambling on Discord when people have asked questions, about like the practical way of reading Gexbot. So I think this is great to have an actual compiled video form of everything that I've sort of been rambling about.
Yeah, that's amazing. I mean, to be honest, as I told you before, I trade basically the ES futures, futures on this on SPX. But I also take positions in the NQ, in the Nasdaq, right? But I don't look into your screen that you guys develop because for me it's quite difficult to understand. So that's hopefully you're here and you can let us know, you can teach us how to use it better.
But yeah, so a little bit about me first. So I had started like learning about the options market from this indicator called Nope. It was created by someone called Lily. And so the idea behind that tool was to track net delta inventory from market makers and to determine, where it might be most likely for hedging flows to come in and cause reversions, right? So the idea was, okay, we're measuring something and it's likely that due to some inventory, we could look for a scalp or a bounce off some level.
Okay.
And then from there, I started reading about spot gamma. I think this is pretty common for a lot of people. I know you, Fredy, also started learning about gamma through spot gamma.
Yeah.
And I would take so they have like pre-market levels, right? So they would measure gamma by open interest. And, generally you would just look for these scalps off these levels.
Yeah.
But for me, I was like, okay, well, sure, these are like static levels that might be working great, but the market changes quite a bit on an intraday basis. So my thinking with Gexbot was, okay, well, maybe I'll start plotting Gex by volume and see how that inventory shifts in real time, right? So that was sort of this very, very start. And like, Gexbot started as a very, very simple, I would make a plot, I would like save an image and I would check the image, and it's grown into this whole thing. And yeah, so, we've also done a lot of work to filter or to really look at our transactions such that, we're not just looking at some naive volume thing. Sorry, I have this set a little bit differently right now.
That's fine. I think it's quite amazing. I mean, like basically when I start to see Gexbot is I was using Classic at the time where you guys were only doing Classic, and it worked well for me for mean reverting trades. So basically all I had to do was the price to go down to the maximum negative gamma or to go up the maximum positive gamma and trying to find a mean reverting trade. But the thing is that was quite simplistic. I mean, compared to what you have right now, because your tools, I mean, the tools that you have right now is like...
It's very limited, right? So like you have effectively kind of 3 pivots. You have like a neutral, right? You have like upside, max upside, max downside, et cetera, et cetera. But there's, spending enough time, especially with, SPX, like it forms it always forms this sort of distribution. Where like you see this curve to the upside, this curve to the downside, and like there's just no granularity, and you can't really tell when like there's actual changing in inventory, like actual shifts in positions. That was sort of the impetus behind something like State, where now you can see kind of the disparate, longs or shorts that come in. I think we were like coming up into major positive, and then we came back down, and there was like these shorts here. Yeah.
Can we go back to the previous the latest on 90 minutes? Yeah. So basically to from people I'm sure the guys in your community, they know about this, but the green bars, that's basically positive gamma, right? So that's actually a magnet for the price to go up. Is it?
So okay, this is something that no, this is a very common discussion. So the way we started initially was, even after we had classified our transactions. Let me actually back up a little bit. So we have, we're tracking these transactions, these contracts. This is just looking at the 0-day or current day expiration. Yes. And then we're saying, okay, these contracts were bought, and so they have positive volume, or these contracts were sold, so they have negative volume. But at the time of creating our Gex profile, like the common, I guess, literature, you could say, especially from like spot gamma, was there's the assumption that calls have positive gamma and puts have negative gamma. But that's really due to, there's that assumption where every call by customers are sold and every put is bought. Therefore, the market maker exposure is flipped. So market makers are long those calls, short the puts, and then such that they're long gamma or positive gamma or short gamma. But in reality, so this is just saying there's a great deal of call gamma. Okay. And the red bars are where there's put gamma, and it's actually ignoring the direction. It wasn't until we developed options profile to then display the actual, okay, this is true. This is what we call long gamma, but this is basically customers being long contracts here. They're being short contracts in the purple bars, and then they're long contracts here.
Because that's interesting that you mentioned that, because in the channel, I also see, in the State channel, I see people get confused, and they ask you many times, is it like, is it the client which is long, or is it the market maker which is long? Who is long? Who is
So basically our view is customer view. So whether that's like, some institution or retail, probably not retail, actually, not an NDX, but generally we're looking at customer positions. And, the reason for that is I know that like traditionally people typically talk about, market makers and talk about the hedging activities. And like there is like a systemic effect from that. But at least what we found is, what's more practically effective is just knowing what the customers are doing, because it's really the customers that are driving the primary flows, right? So they're hedging. So we can think of it as sort of a chain, right? So like customer is trying to put some position on with respect to the index, and then they come to the options market to put on their hedges. And then subsequently, market makers who are accepting those trades, then they're hedging their flipped version of that trade. And there's all these second order effects from that. But I think it's more important to think of, okay, well, the customer came in and they're hedging long gamma here. And what does that mean, or how does that affect spot price? Or they're long gamma here, how does that affect spot price as we come into, these levels?
Okay.
And to be more concrete, like, and I've said this in like the chat and whatnot, but I do want to say here, like, it's very, very, I think it's less complicated than it needs to be.
Yeah.
So it's literally just people are, if they're long gamma, they're long volatility in this area, which just means that like they're expecting a move away from this level, right? So if you think about being long a straddle, right?
Yes.
What you're really asking for is spot to move away from wherever that strike is. And that's all that this is. This is, just, I know that there's a distinction between whether you're looking for reversions off a long call gamma or long put gamma. But all that matters is that someone is long volatility in this point. And so we're looking for reversions off long gamma. I don't have this loaded, actually. I'll load this while we're talking.
That makes a
But
lot of sense.
yeah, that's like the core of how I think about long short gamma. And then there's other aspects of like call and put gamma, a little bit more. I think they would be secondary in terms of thinking about shorts in control or longs in control. But so like I think this is around 12 today, where we were auctioning up to, I think it was 701, yeah, NQ. And then right here is this position that gets put on.
I see that.
And it's just the cap, it's a ceiling, and we're unable to push through, and then spot price rejects off of it. And
Because
then we come back to the other pivot here.
I'm not sure if I'm doing it right, but the way I think you put it in the chat, and please correct me if I'm wrong, but if the spot price is above of the gamma levels in that, let's say like where you are now, we use those gamma levels as a support. So as you said before, those guys in the options market, they want the price to go as far away as possible. And once, like now, the spot market, the spot price is below that gamma level, that's actually kind of resistance. So those guys, so that's the net effect is a barrier, is a resistance, and we would expect the price to come down. Is that all right? Is a good way to analyze that or not?
Yeah, I think it's really important to think in terms of like just pivots, and maybe this is a little too esoteric, but to not like, I try not to think about direction very much, if that makes sense. So like,
Okay.
There's a common saying like in futures, right? Like I don't even say that, but like don't diddle in the middle, right? Where like don't get stuck in the middle of the range, right? You're looking at like the most extreme ends or pivots, right? Entries where you can kind of define where your trade is wrong. And so like it's, partly it's like, yes, if we're underneath it, it's resistance. If we're above it, it's support. But it's just, this is an entry for looking for spot price to go away from this level. I brought this up before to someone a while. This is a long time ago, where like we had the thought of flipping the chart, sideways, so that you're not trading up or down, you're just trading left to right, in order to remove like the directional bias. Because I know that people have a hard time shorting because people are much more used to going long. But I think it's probably too esoteric to flip the chart. But like trying to think in terms of, not about like, no, it's not totally true, because if you look in a long-term basis, there's drift, right? Like at least the American market always goes up, so like you should have a long bias. So like it's not true that there isn't a difference between being long or short. But I think on an intraday basis, like it can help thinking about that. And like that's all that this is, right? This is just about finding those points or those areas where you can look to enter or exit, right?
Yeah, because this is like kind of, the more you do it, the more you watch it, the more you kind of get some, I don't know, some knowledge or something into your eyes. So you kind of recognize what's happening. And for instance, when the price went up to to the top, no worries. It started to come down, and then on the left hand side you got the purple bars. and that purple bars are like kind of negative gamma, right? So
Yeah.
so
Well,
if
it's
you see,
funny, at least on NQ, I realize I don't even look at the, I just straight up ignore them. I'm
that's what
kind
I'm
of
going to
realizing
ask you,
now.
because every day you see those bars every day. I mean, and you see many of them. So I didn't know how to really understand those purple bars, because I thought like, well, this is people with negative gamma or what it is, or should I ignore that? What do you reckon?
So, I think for a lot of futures traders, I think really an easy analogy to understand, because I'm sure a lot of people are familiar with like volume profile.
Yeah.
And so in volume profile methodology, typically people are thinking about let me actually draw this. So people are thinking of like this distribution, right? Right. And this is like your volume profile, and then you have your, not VAL, but like you have your upper ends and lower ends, right?
Yeah.
And then
I think you're not something happened because I'm not seeing what you're showing.
oh, it's not. Oh, got you. Okay. Well, that's fine. So people are thinking about, a volume profile, right? Sort of like this.
Yeah.
And, there's the high volume node, which is an HVN. And the thinking is that historically, this is where the most volume transacted.
Yeah.
And so the idea is that this is where the highest liquidity is, because this is where people are most willing to transact. And, because the auction is about matching buyers and sellers, right? It's not
Yep.
really about speculating, it's about facilitating transactions. And so like if you're in a high volume area, it's very likely for spot price to get stuck, so to speak, just because it's sort of found its fair value kind of, and there's no reason for it to move. Now in futures, all we care about is like spot price moving, because that's all that we can trade, right? Like we're not trading options, we're not making plays off of volatility. So we tend to avoid high volume nodes. And the converse of that is low volume nodes, right? Where the thinking is that people are unwilling to transact here because there weren't many transactions historically. And thus, if you're going to join some trend, or if you're looking for some reversion trade, you're trying to enter in some low volume node or low volume area. Now, this is quite literally that. So long gamma is basically the equivalent of a low volume node. And short gamma is the quote unquote equivalent of high volume areas. And that's what I mean by like, I literally only look at long gamma in the sense of, if you're trading futures, typically you want to avoid high volume nodes in the volume profile, just because it's very hard to define like your thesis, right? It's really hard to define where you should place your stop, because like distribution get pretty wide, right? So you try to stick to these areas. Now,
Okay.
that actually brings me to another point, right? So like I started with order flow, or I started with like footprint.
Okay.
There's a lecture by Brannigan Barrett. There's an Axia Futures lecture, which is really great. But no, so my background was like, okay, I would look at footprint, I would look at order flow, I would look for absorption and initiation, right? And then that's how I would determine entries. And then the combination of that, or I would combine that with volume profile, right? So in volume profile, I'd be like, okay, well, this is like low volume area. I want to traverse the distribution to go to the other end, right? What I found was that, like, at least for me, footprint was just very noisy. On like a tape reading level, it's very difficult. It takes a lot of screen time to really understand what the hell is going on.
Yeah.
And if you try to quantify it, it's very prone to overfitting. What I mean by overfitting is like, okay, maybe we see absorption at some level, but what is the significance of that, right? Like, okay, yeah, someone's loading a large amount of volume, and so that implies that maybe that's the weekly low, but you don't really have any concrete way of measuring, okay, what an actual large amount of volume is, right?
Yeah.
Secondly,
Understand.
it's also very localized, right? Like you can only see order flow at wherever spot price currently is. And so you're looking at it and like you don't really, I mean, that's where volume profile comes in, right? Where you have a map and you
Yeah.
have a bird's eye view and you look for the pivots. So that kind of, at least for me, like that's where Gex profile sort of combines both of
Yeah.
them. So we have, the way that we're classifying transactions is not arbitrary, meaning, we're not like trying to torture some parameter so the model says to buy. We're also not doing something as I don't want to say simple, but like doing bid ask classification is not really correct either. But we're basically doing a way that there's a fundamental reason for why we classify things the way we are. So we have that order flow classification in the option sense, but simultaneously we get the bird's eye view of volume profile. And it's not historical like volume profile, it's real time, right? Like these are active positions that are occurring right now. And so like we can be sure of, okay, well, we don't need to worry about whether we're looking at a daily or the weekly or the monthly volume profile. Like this is all forward looking.
Mm-hmm.
And additionally, they have an expiration, right? So maybe someone's getting long in the futures market because they have some expectation of like end of year flows or something. But these are zero GTEs. Like this matters here now. We have a target, which is like today. And like so we can clearly define the limits for our view into the market.
Yeah. Like
I hope that all.
and yes, no, I mean that's the whole point. And what I show at the beginning, that zero DT options are basically more than 50% of the total flow on a daily basis. That's there are some research of good companies that actually show that even Spot Gamma does it. And they have a tool where you can see, the total volume of options here, like, I don't know, $1 billion. And then half of that is zero DT. So I think that's why it's important, like for you futures traders like us, which day traders, basically we want in and out very quick. This tool is fantastic, but understand the tool, understand, basically what you just told us before. I was looking at those purple lines before and say like, oh God, market is going down. But the way you mentioned is fantastic. It's not simplistic, but is when you are looking so many things and you explaining is that simple that saves a lot of time and headaches and and many things. But I was talking to John the other day and tried to understand that the volatility skew and how to combine that with the chart. And probably you can give us also, as you're a futures trader, you can give us your point of view of how we can actually analyze that.
Yeah. So one thing I want to say is that like the way that we are displaying skew in like a traditional manner, I think I probably can't say that now, but there are improvements that we want to make to this view to make it more usable from an execution standpoint. But like so the core of skew is not. It's really simple. I think so. I'm sure if you've traded futures, you're familiar with Bookmap, and if you're or maybe even like Ninja Trader, like or like the DOM, right? So like I know that people like looking at stacking or pulling of limit orders on the order book to kind of suss out, okay, maybe there's a willing buyer here or there's a willing seller here, right? And so like skew or the vols are literally, it's basically a measure of liquidity in the same fashion that the limit order book is when you're looking at like the heat map on Bookmap. But these are actually being traded. So these are not limit orders that are, because yes, there's laws against spoofing, like, there's some degree of like, you don't really know, right? When you're looking at the DOM, whether someone's being real about whether they want to put this risk on or not. Like you just don't know. And oftentimes, like I've seen so many stink bids on like the DOM where it's, you know, someone at like 3,500, I remember putting some limit order in, and it's like, okay, well, you're not serious. Like I know you're not serious. It's just like messing with people, right? But no, these vols. So to clarify, these are the vols of the contracts, the corresponding contract. So this would be, if we were looking at SPX actually, this is just the value or the implied volatility of the 5815 puts. And volatility, I think it's easiest to think in terms of it's just the value of that contract. It's normalized in a sense because there's a time dimension to these options, right? But in effect, you can think of them as the value of them. And so basically someone is trading, or participants are trading these contracts, and it's implying something about the liquidity, right? And so another part of that is you can think of volatility as the inverse of liquidity. So I think the easiest to understand example is, it's not so much now, but during like Fed minute meetings, I'm sure everyone's seen where everyone leaves the LOB or the limit order book, and you know, you're watching NQ and it's just like surging around because there's no liquidity, because no one's willing to transact because like, you know, J-Pow might be about to nuke the markets, right? And so like that's high volatility due to a lack of liquidity, meaning a lack of willing auction participants. So, and the same concept applies here. So this being higher vols means, and by higher, I mean, this is along the x-axis. So if the vol is to the right, it's higher volatility. If the dot is to the left, it's lower volatility. So higher volatility means less people willing to transact in this zone, and lower volatility means more liquidity or more willingness to transact here.
Okay. Yeah. It makes.
I know it's a little. That's the jargon. That's a bit much.
Yeah, but I remember like kind of conversation with John, and he mentioned basically is also how cheap or expensive is an option.
Yes.
And how are the options guys are willing to pay for more expensive options, like the expensive options above. They say like, well, the options guys are not gonna bid for those prices because they're quite expensive. So you might, if you are long, you know the price is not gonna go, it's not rocket right now because you know options are not gonna buy options above those levels. As it's sort of kind of.
I think there's a core. So like, you know, if you think about literally what an option is, right? If you're purchasing an option, you're purchasing the right to then transact, right? Like if you're buying a call, the right and obligation, blah blah blah. You're saying that you're willing to buy at this level. But if volatility is very high, meaning the contract is very expensive, so it's less likely that people are willing to buy that, meaning that they're less willing to transact with that option, right? And so like, you know, the impetus is to sell it, although that's not, you know, recommended because you don't want to just sell kinks in this queue indiscriminately.
You know, like we in South America, and John is from Argentina as well. We like simple and easy things. So we thought, okay, you know what? Imagine it's a rock climber, and the guys it's going very easy up to where is the price right now. You know, it can go very easy to 58.75, but going up is going to be very hard and very tough for him. You know, imagine you're climbing that rock on the, you know, with
I mean,
with everything against you. So that means price is not gonna go there. So get out. If you're long, you know where to get out, and it's probably at 58.90. I don't know, some level like that, because you know it's quite difficult the price to go up with this.
Yeah, I mean, my preferred analogy is like spot price is, and I've said this so many times to John, he knows it right now. Like my preferred analogy is like spot price is a ball, and if you just think about this as like, you know, it's a slope, right? So where does the ball want to roll? You know, where does it want to slide? Where is it easier for it to slide, right? And if you think, because I think it's easier to think in terms of in physical terms often,
Yeah.
just because it comes naturally to people, right? And like, yes, there's a lot of there's quite a bit of theoretical justification for why that is the way it is. But you know, practically speaking, if you just think in terms of like it's a ball and spot price wants to roll on that hill. And actually,
Yeah.
so that comes to actually dovetails really nicely with the idea of long or short gamma. So like long gamma, when I'm thinking about gamma, I'm really thinking about the vols. So when we're displaying these vols, this is like the latest vol that had occurred. Um, and if we're looking at the gamma, right? So if you're long gamma, that means you've likely lift or you have lifted the volatility of the contract. That's how that gets classified that in such a way. If you're short gamma, it's because you've depressed the vols there. And that was the effect of that transaction. And so long gamma just means that they had lifted the vols at that point. And so when we're talking about when I'm talking about like reversions off of long gamma, it's the same concept of, you know, the skew being less or more liquid in some areas, right? So long gamma tells us the history of that part of the skew being less liquid, meaning there's more likely to have reversions off of it. And short
Yeah.
gamma is telling us the history of the skew being a lower volatility, which implies a higher liquidity, which means less reversion and more momentum. You know, there's a lot of like flip-flops,
Mhm.
but like, you know, I find it helps to just sort of write it out, and that helps with like
Yeah.
thinking about it,
I don't
or
know if you
just
can
like
share with
staring at them
us.
forever.
I don't know if you can share with us. You in the channel, you make a really nice kind of
Oh
explanation.
yes. Where is
Do
it?
you have that so we can show to people? Because when that volatility skew is flat, it's when you see the market just go down or just go up very aggressively.
Yeah, let me try to. I'm trying to download. Where is this thing? Hold on.
There you
Can you
go,
see
that
it?
one. Yes.
Yeah, so this is. Yeah, I probably should have had this up the whole time. So this is just how I think of the vols, right? So it's like, let me just outline the cases, right? So like, I'm literally just looking at the shape of the dots, right?
Yeah.
And again, so if there's higher volatility, and by higher I mean the dot is to the right, um, then spot price higher volatility is less liquidity, meaning spot price is less likely to transact there. So in
Okay.
this case, you know, the vols are higher underneath spot and they're lower above spot, and therefore it's easier for spot price to move towards higher liquidity, right? So because volatility and liquidity are opposites. And interestingly enough, you know, so this is a little bit different depending on the asset or the instrument, right? So like this is the classic SPX skew
Okay.
where customer or participants are generally long puts or long volatility underneath spot, and they're short calls. So you can think of like the JPM collar as like a typical
Uh-huh. Yeah.
example where they are not expressing a directional bias. They're just putting a hedge on. But the nature of that hedge is such that it is actually inherently bullish because it's just more difficult to push down into lifted vols, and it's easier for spot price to go up. You know, whether this is like dog wagging tail or tail wagging dog, because traditionally, you know, American stocks over time always go up, right? So there's a bit of that baked in, but you know, that's for another discussion, I think. Now, other forms of the skew can appear, and these are really more often, they're not common. I would say that like these are most obvious during events and or event vol. And what I mean by
Mhm.
event vol is something like, you know, FOMC, although that has definitely died out a little bit. If you're looking at something like individual equities, these kinds of other forms of the skew are definitely more apparent. Well, event vol actually looks a little bit different. It's really it's a slope that's inverse of this, right? So it's like a hill. But it's all about like spot price being located somewhere in the skew, and where's liquidity, and liquidity is wherever the vols are the lowest, right? So you're just looking for the ball to either roll down the slope, or maybe it's stuck, right? Because like it's sloped on both ways. This actually happened yesterday at the close, right? I think people were short the 15 and 20 calls in SPX. We got up to that level, skew flattened out, or really it became like this, and then we just closed in between those short strikes. And then there's this example, which is not as common, where skew is just straight up flat. And the effect of this is really that, like, if there's spot price movement, it's a lot easier to get momentum going. So like, this is kind of the ideal. I mean, it depends on your bias, I guess, if you're trading futures, right? Like you either want this, or if like you're bullish, or if you're if you're looking to short something. I will say though, like from a practical perspective, right now it's there's still work to be done with actually making these vols usable in a way that like you don't have to be staring at it like this, because it's very difficult to get that same reading.
Yeah, no, but you know what, Jass, it's been useful, to be honest. I've been taking positions where I go long, and then using the analogy, like your ball analogy of the rock climber.
Yeah.
I say like this.
Yeah.
I go a maximum gamma level at the top, and on top of that, I see the skew. I'm right in the middle, so the price is not gonna go any higher.
Yeah.
And that's where I get out, basically. I've used it a couple of times, to be honest, and it's been quite helpful. But I know many people in South America, they have seen your videos in YouTube.
Oh.
And yeah, no, they do. They call me and they contact me and they say, like, can you explain this? Because
that's wild.
They hear about the concept of gamma. I'm telling you, here it's all about support, resistance, triangles, moving average. But when people go and see this and they say, okay, there's something, something going on behind the scene.
What the hell are they looking at? Yeah.
Yeah. And obviously, as I said before, the classic Gexbot was kind of easy to read, but now you guys with all these tools, you really need time, and thank you for this explanation, because it makes the life of these guys our lives easier to trade every day with your tool. And I didn't know if no, honestly, that's why I say I need to talk to Jass and make a video, because I really want my story. I was an institutional trader, and when I came back to Colombia, I was in London, and when I came back to Colombia a couple of years ago, I saw people here don't know about this. They just still buy courses for these gurus and stuff, and what you guys doing is amazing, and people here should know it, should know about it. But just probably, I don't know if it's too much for futures traders, but I think it was yesterday. I think a client, one of these, big guys, they put a kind of put a spread or debit a spread credit, I don't know, and everyone in the chat was like, oh my god, this is, and the price never went there. It was some put or something like that. And then you mentioned, I quote, I don't. Yeah, I was Monday. You say, I don't care, all I care is that these people leave that part of the ball surface and make it more expensive, so the spot is not going to go there. Can you just kind of explain us a little bit more of that?
When we say that we're looking at a customer view, and by customer view, I mean if it's a customer that went long gamma here or long gamma here, and that's like their position. It's not quite true. In a sense, this is kind of philosophical, but it's sort of not true in the sense of really what we're looking at is the impact of some participant, with his own incentives, whatever he's trying to do, he's coming in to the system and he puts a position on that affects the system in such a way. In such a way that it shows up as being long gamma, or on Monday, it was long puts, right?
Yeah, they were long puts. Yeah.
But whether or not the participant is whatever his incentives are, it doesn't really matter whether he's speculative or hedging. What matters is how he's affected the system, because for one thing, there's just no way, it's epistemologically impossible to know whether what that participant's intentions are. Yes, you can go into SIBO open close and you'd be like, okay, well, he was doing this, he was rolling that, right? But really, there's just no true way to know what his intentions are. But what we do know is the effect that he had on the system. And that's something that we can rely on and we can actually trade. It's both, we know that he had impacted the system in such a way that, if he's long some puts, he's really just making it less liquid to trade in that area. Because if you're lifting the vols in some area, that means there's less liquidity there. You think of it as establishing a low volume node, but with an active position. That is kind of the effect of going along those puts, whether he was betting on downside or not.
Yeah.
And so,
It's
we don't know what he is, right? But we do know the effect. And that also has the secondary effect of execution is so much simpler if you're not trying to reason as to why someone is doing something.
yeah.
It kind of doesn't matter. If you're okay, someone's going along and you could be okay, but why would you go long here? Spot price has already been going up for so much. Why would you do that? Well, it doesn't matter. He's fucking going along. Just follow him.
Jass, I do kind of sympathize with many people in the community because if you go to latest in Get's profile, what would happen is that level at the moment, 5,000 that's on the downside, the maximum negative gamma. Yeah. So basically, I've been using Gexbot for a couple of years now. So basically, that's telling me that that's a magnet and the price, because when you see the let's say the kind of normal distribution that you have there, you see there is more, let's put it, negative gamma there than positive. And you might think, Jesus Christ, that's a lot of negative gamma. So the price is a magnet and the price might go there because the market maker might need to hedge those flows by selling futures, right? So when you see a big position like the one we saw on Monday, I tell you, I was long. I was long the futures, and as soon as I saw that position, I was like, holy crap, and I cut my long. And you know what? The price never went there.
Yeah.
So and many guys in the chat, they were also kind of, what, this is gonna go down or no? We're long, we're cutting the longs. So it's when you look at it into what you just mentioned, that guy is lifting the volatility surface and is making the option more expensive. So less likely the spot to go there. It goes against at least for my.
It's very counterintuitive.
Yeah,
I think that because it's just a lot of talk about the options market that is very misleading. That's kind of because the option market is so, and to be clear, we're talking about SPX, index options, right? Primarily, it's not a speculative instrument. Like that's just not what its purpose is, you know. So people are very used to thinking in terms of you know, I mean, a SPY is kind of reflective of this, where it's like, okay, you come to the options market to make a leveraged directional bet, right?
Yeah.
And that's kind of what fuels the thinking of, okay, well, someone's going along these puts because like they're betting on downside. But like in SPX, partly, you know, there's multiple factors in this, right? So like the rise of short vol, you know, people selling volatility makes it very hard to profit off of being long vol or long gamma. It's just very difficult to monetize stuff, especially if you're trying to move size like that person was or that participant was on Monday. You know, okay, maybe if you were making a speculative bet like that, they would have required like SPX to drop significantly, because just the very act of like taking profit on those puts is going to shove, not by itself, but people, you know, because there's a feedback effect, you know, when you're trying to take profit or close positions like that, that can make it very difficult to monetize it properly. So more often than not, again with SPX, it's for hedging, right?
Yep.
Now that doesn't mean that we can't trade off it speculatively, but it does require slightly different thinking. And in
Yep.
fact, like because it has that purpose, we can still be very clear on like how exactly we're classifying flow. It just requires a little bit of a different reading of how to utilize that.
In my previous conversation with John, we kind of agree, and I think I put it in the chat in Twitter. Basically, to go directional, you have to look the SPY, not the, you know, and that's what I do. I go directional, look in SPY, and SPX. I use it for levels to get out, basically, like, you know, to take profits, and because those levels, like today, what was 59.22? That was the maximum of the recent rally on ESPX. So basically, went there and
I remember that. Oh,
so
they exited too.
Yeah, but at that time, if you go back in time, like a couple of hours ago, that was the maximum kind of. I think.
Major call was right there.
But to go to that directional trade, I was looking SPY and yeah. So